All right, let's unpack this. We're taking a deep dive today into a concept, market attractiveness. Sounds a bit like jargon, maybe?
It can, yeah.
But trust me, getting a handle on it is really, really important, whether you're looking at companies, whole industries, or even, opportunities for yourself.
Absolutely.
So we're exploring what it actually means, why it's such a big deal, and, crucially, how you measure it.
And we're grounding this discussion in a specific article that you, the listener, shared with us. It focuses right on evaluating market attractiveness and feasibility.
Right.
So our mission really is to zero in on the key insights from that source, kind of cut through the noise and get to the core understanding of why this matters and the practical frameworks it suggests.
Think of it as us giving you the shortcut to the important bits in that article. We'll pull out some maybe less obvious points, some frameworks that are, well, key to getting it.
Sounds good.
So let's jump right in. What is market attractiveness, according to this source, and why should you care?
Okay, so the article defines it pretty simply, actually. It's basically a metric. It quantifies how much capacity a market has for increased sales and profits.
Capacity for sales and profits.
Yeah, it's assessing how fertile the ground is, for a business to really grow and thrive.
Okay, seems straightforward enough. But the source makes a really critical point early on about how you figure this out, doesn't it?
It does, yeah. And this is crucial. The article really stresses that the evaluation has to be unbiased. You've got to use outside data.
Outside data. Why?
Well, even though your own company's goals will set the criteria for what you want in a market, your current position, or like how well you're doing right now, that shouldn't color your view of the market itself.
Ah, I see.
You need that objective look, sort of from the outside looking in.
That makes total sense. You need the clear map, not just your opinion of your own little spot on it.
Yeah.
Okay, so why is this external, unbiased view just so fundamental for strategy?
Well, the article lays out a few key reasons. It presents it as like step one, a necessary first step whenever you're reviewing your overall business strategy, or maybe thinking about entering a totally new market, or even evaluating potential acquisitions or investments.
So foundational stuff.
Foundational for those big strategic calls, yeah.
Okay, big picture. But then the article hits us with a really powerful idea, maybe even a bit counterintuitive,
Yeah.
about it putting a limit on profitability.
Yes, this is a core takeaway from the source, definitely. It argues pretty forcefully that market attractiveness puts a ceiling on how profitable any business in that market can ultimately be.
A ceiling. Explain that a bit. How does that work?
Well, the idea is even if you have a perfectly run business, fantastic operations, great strategy, everything's clicking, if it's operating in a market that's just fundamentally unattractive,
Yeah.
meaning, maybe it has intense price wars or very limited growth prospects, stuff like that,
Yeah.
then its profit is inevitably going to be capped, constrained. It can only go so high. But flip side, a business in a really attractive market, even if it's just, reasonably well run, not perfect, it has the potential for substantially higher profits.
Okay.
The market environment itself kind of dictates the upper limit of the potential return.
And that's a really sharp insight. So operational excellence is about hitting that ceiling, getting as close as you can.
Right.
But the market attractiveness is the ceiling. It sets the maximal height.
Precisely. And that perspective, which comes directly from the source, is why understanding market attractiveness is so vital for strategic planning, especially scenario analysis. You're figuring out your potential within those fixed environmental limits.
Makes sense.
And the article also points out, that the value of an existing business, like for mergers and acquisitions, is heavily tied to how appealing its market is.
And didn't the article mention a common mistake investors make here?
It did, yeah. It flags that investors often focus, maybe too much, just on past financial performance when they look at a company.
Right, the track record.
Exactly. But they might overlook the fundamental attractiveness or lack thereof of the market it's actually in. Past success in a market that was maybe booming temporarily but is structurally weak, that can be misleading.
That's a huge potential blind spot then. Okay, so market attractiveness is critical. It caps profit, needs an unbiased view. But what makes a market attractive or not? What are the specific factors according to the article? My first thought is always size and growth.
Yeah, that's common.
But the source says look deeper.
It does. While size and growth are definitely part of the picture, the article explicitly states that other factors are often more crucial for long-term attractiveness.
More crucial than size and growth. Interesting.
Yeah. And importantly, it also says the relative weight you give these factors, it varies. It depends on your organization's specific vision, its goals, its objectives.
So it's not one size fits all. Depends on what you're trying to achieve.
Exactly right. But the source does group the key characteristics into three broad, kind of overlapping categories.
Okay, what are they?
Differentiation potential, pricing potential, and growth potential. These are framed as the main lenses for viewing a market's appeal.
Let's break those down based on the source's angle. Differentiation potential. What's that about?
So this is about the market structure and its dynamics, basically. Do they allow a business to offer something genuinely distinctive, something valuable that stands out?
No.
The article suggests that aspects of the market's attractiveness directly impact your potential return and therefore your ability to actually create and capture value through differentiation in that specific environment. Can you realistically be unique and get paid for it here?
Got it. So it's not just can you be different, but does the market let you win by being different? What about pricing potential?
Well, differentiation obviously helps with pricing, but the article emphasizes that pricing potential is also heavily shaped by the competitive landscape, the fundamental industry structure. That structure dictates how intense the competition is and the resulting pressure on prices. Are you in a market where you can realistically command a profitable price, or is it always going to be a race to the bottom because of fierce competition?
Right. That connects straight back to that profitability ceiling idea we talked about.
Exactly.
And the third one, growth potential. Still important, but maybe with a twist.
Yes. Still vital. Absolutely. Market size, overall growth rate, those matter. But the nuance the article adds here is that understanding the precise market segments you should target within that potential growth, that's even more crucial.
Segmentation.
Right. It's not just about is the market growing. It's about finding the specific profitable pockets of growth within it that really align with what you do well with your goals.
Okay, so the key factors are really about the market structure, letting you stand out, charge decent prices, and find specific growth areas, all impacting that ultimate profit potential.
That sums it up well.
Now, how does the article suggest you actually analyze these things methodically? It mentioned several tools, right?
It does, yeah. The source outlines several well-established methods and frameworks you can use to gauge attractiveness and also to compare different market options. They give you a structured way to look at the forces at play.
Porter's 5 forces comes up a lot. How does the article position its use here for attractiveness?
So the article presents Porter's 5 forces as a tool specifically for analyzing the competitive forces inside an industry. And those forces directly shape its attractiveness.
Right, the 5 forces.
Yeah, The threat of substitutes. Can customers easily find alternatives? Bargaining power of suppliers. Bargaining power of customers. The intensity of rivalry among the current players. And the threat of new companies jumping in.
Yeah.
Using this framework, the source says, helps you understand those underlying power dynamics. You assess the fundamental level of competition and what that means for potential profitability in that market. It's really a tool for dissecting the structural challenges or maybe the advantages.
So it's about seeing how the industry setup itself might squeeze profits. Makes sense. What about PESTEL analysis?
PESTEL, yeah. That stands for political, economic, social, technological, legal, and environmental factors. The article presents this as a framework for looking at the broader external environment.
Broader than just the industry.
Exactly. It helps organizations spot and evaluate those bigger picture external forces that could impact the business now or down the road.
And how does that relate to market attractiveness specifically?
Well, the article states that doing a PESTEL analysis supports your market research and strategic planning because it identifies opportunities and challenges coming from outside the immediate competitive arena. It's about understanding those macro-level headwinds or tailwinds that could affect a market's long-term appeal and potential.
Okay, so moving from industry structure to the wider world. Got it. The article also mentioned 2 matrix tools. What about the BCG Matrix first?
Right, the Boston Consulting Group Matrix.
Yeah.
That's described mainly as a product portfolio tool.
Portfolio tool.
Yeah, it helps businesses analyze their mix of products or services. You map them onto a 2x2 grid based on relative market share, which is kind of a proxy for competitive strength and the market growth rate.
So how does that link to market attractiveness?
Well, while it's often used for managing your existing products, that market growth rate axis directly ties into one aspect of market potential we discussed earlier.
Ah, the growth potential factor.
Exactly. So the article implies it helps categorize your businesses or products based on whether they're in markets with high or low growth potential, giving you that high-level view of the dynamics they face.
Okay. And the last tool mentioned was the GE Matrix, or GE McKinsey.
Yeah, the GE McKinsey Matrix.
Yeah.
This one is presented as a strategic framework that's especially handy for companies with multiple business units, SBUs.
Strategic business units, right?
Right. It uses a bigger grid, a 3x3 matrix, and it looks at two key things for each SBU: its competitive strength and, crucially, the attractiveness of the market it's in.
Ah, okay, so this one explicitly puts market attractiveness right there on one of the axes. How does the article say it's used in practice?
So, by plotting your different business units based on how strong they are competitively versus how attractive their market is, the article explains the matrix helps you answer those tough resource allocation questions.
Like where to put your money?
Exactly. It guides decisions on where to invest, which businesses or products maybe deserve more focus, or even which ones you might consider selling off, all based on where they land on that strength versus attractiveness grid. It directly uses the concept we've been discussing to shape portfolio strategy.
That makes a lot of sense, guiding your bets based on both how good you are at something and how good the game itself is, the market potential.
Precisely.
So bringing this all back to you, the listener, we've seen how this source defines market attractiveness. It's not just about size, is it?
No, definitely not.
It's a crucial, multifaceted metric that, importantly, fundamentally limits a business's potential profit. That ceiling idea.
Right, the ceilings.
And we've looked at how the source highlights key factors, like your potential to differentiate, your pricing power, finding targeted growth, maybe even more critical than just overall size. And we've explored those structured tools the source suggests for analyzing these dynamics. Porter's 5 forces, PESTEL, the BCG Matrix, and the GE Matrix.
And these aren't just, academic exercises. They're practical lenses. They help you understand why some businesses seem to thrive almost effortlessly while others really struggle, even when they're trying hard. Or they help you evaluate where the real potential might lie in an opportunity.
Yeah, absolutely. And that leads to maybe a final thought for you to chew on, building on that core idea from the source about the profitability ceiling.
Okay.
If market attractiveness really does set that limit, how might you look differently at a company that's incredibly successful, like really knocking it out of the park, but they're doing it in what seems like a genuinely unattractive market?
Good question.
What does that tell you about their execution? Or maybe their specific niche? Or just their sheer ability to navigate those tough structural challenges?
Yeah, it forces you to think about what exceptional performance really means when the market itself isn't giving them an easy ride, is it? When there's no natural tailwind.
Exactly. Something to ponder as you watch businesses operate or size up your next move. Thanks for diving deep with us today.